Okay, let's dive right into this explainer and launch a full-blown investigation into history's most notorious financial crisis. Autopsy of a Crisis, Decoding the Great Depression. We're going to look way past the standard textbook definitions to really dissect the anatomy of this decade-long catastrophe. How did a stock market crash in New York somehow freeze the entire global economy? What were the underlying vulnerabilities? And maybe most importantly, how did we finally cure it? Let's get into it. To set the stakes right out of the gate, consider this absolutely staggering statistic. Between 1929 and 1932, worldwide GDP fell by an estimated 15%. But in the United States, the economy contracted by a massive 30%. 30%! To put that into perspective, entire industries literally ground to a halt. International trade was sliced in half, and in some areas, unemployment rocketed right past 30%. So we're not just talking about a bad recession here. This was an absolute, complete systemic failure. Because we're tackling a super dense decade of history and a really fierce battle of competing economic theories, we're going to use this roadmap to guide our autopsy. Chapter 1, the crash of 1929. Chapter 2, spreading the global contagion. Chapter 3, explaining the economic collapse. Chapter 4, the debt deflation spiral. And finally, Chapter 5, turning points and recovery. Part 1, the crash of 1929, the end of the Roaring Twenties. We have to start our investigation with the initial trauma that shocked the global system. Over just a few days in October 1929, an unprecedented panic set in. It all kicked off on October 24th, Black Thursday, with an 11% drop. Wall Street bankers scrambled to stabilize things, but honestly, the fear was already spreading like wildfire. By Black Monday, the market dropped another 12%, and the very next day, Black Tuesday, saw yet another 11% wiped out. In a matter of days, billions of dollars vanished into thin air, entirely ruining thousands of investors who suddenly found that their stocks literally couldn't be sold at any price.
So the stock market didn't just take a dip, it practically evaporated, dropping from a peak of 381 in 1929 all the way down to a devastating low of just 41 by 1932. That means the market lost 85% of its total value. 85%! All that boundless optimism of the Roaring Twenties was just completely erased. But, a stock market crash alone doesn't automatically equal a decade-long depression.
Which brings us to Part 2, spreading the global contagion. From domestic panic to worldwide depression. The crucial question here is how an American stock market crash infected the entire globe, right? Well, the hard data proves this was a truly global contagion. The numbers from 1929 to 1932 are absolutely wild. The U.S. saw industrial production drop by 46%, but Germany was right there with them, suffering a 41% drop. And get a load of unemployment. In the U.S., it spiked over 600%, but the UK, France, and Germany, they all saw massive, triple-digit surges in joblessness too. Foreign trade collapsed universally across the board. The world's economies were inextricably linked. And a major accelerant to this global fire was protectionism. In an attempt to protect its own domestic industries, the U.S. passed the Smoot-Hawley Tariff Act in 1930. The idea was simple enough, right? Tax foreign goods so Americans would be forced to buy local. But it backfired completely. Other nations immediately retaliated with their own tariffs. The result was a staggering collapse in international trade. American exports dropped from over $5 billion to just $1.7 billion in a few short years. Economists almost universally agree this move severely worsened the crisis. But the ultimate transmission mechanism, the thing that really spread this economic virus, was the gold standard. Because currencies were rigidly tied to gold, countries couldn't just print money or adjust exchange rates to stimulate their economies. If one country raised interest rates, gold flowed out of other countries. To stop losing their precious gold reserves, central banks throughout the world were basically forced to reduce their money supplies. This triggered forced deflation across global markets. In fact, historical data shows that the earlier a country abandoned the gold standard, the quicker it actually recovered. Let's move on to Part 3, explaining the economic collapse, interrogating the suspects. Now, we're going to impartially examine the great academic debate over what actually caused the collapse to be so incredibly deep and prolonged. We have two heavyweights of economic theory here. First, the Keynesian view. This theory argues that a massive loss of confidence led people and businesses to simply stop spending. Aggregate demand just vanished. Therefore, they argue governments needed to step in, run deficits, and spend money to restart the economic engine. Then you have the monetarist view. They point the finger directly at the Federal Reserve, arguing that the central bank just passively watched as a third of all banks vanished and the money supply shrank by a catastrophic 35%. Without money in the system, the economy simply choked to death.
To give a modern voice to that monetarist theory, former Fed Chairman Ben Bernanke actually famously admitted the Federal Reserve's disastrous role in the contraction. During a 2002 speech, he said, quote, "Regarding the Great Depression, you're right, we did it. We're very sorry, but thanks to you, we won't do it again," end quote. By failing to act as a lender of last resort when banks started failing, the Fed effectively allowed an ordinary recession to snowball into the Great Depression.
But to maintain our neutrality here, we also have to look beyond the mainstream at some heterodox theories that offer completely different culprits. The Austrian school, for instance, argues the real mistake happened way before the crash. They blame central banks for inflating the money supply in the 1920s, which created this fake, unsustainable credit-driven boom that was always bound to pop. Meanwhile, Marxist theory views the crisis not as some policy failure, but as an inescapable feature of the system itself. They argue it perfectly proves the inherent instability and contradictions built right into the capitalist mode of production.
Next up, Part 4, the debt deflation spiral, the mechanics of the downward spiral. To really understand the day-to-day mechanics of this crisis, we need to talk about margin calls. Back in the 1920s, people bought stocks on margin, meaning they'd borrow, say, $9 for every $1 they actually had. Well, when the crash hit, brokers demanded that borrowed money back. Debtors couldn't pay, which led to absolute panic. Terrified depositors rushed to pull their cash out of banks all at once, triggering massive bank runs. Ultimately, this wiped out 9,000 U.S. banks over the decade, evaporating billions in everyday savings. I mean, just imagine waking up to find your entire life's work simply gone.
Economist Irving Fisher described this as a vicious paradox. Step 1. Everyone panics to liquidate their assets to pay off their debts. This distress selling leads to Step 2, a contraction of the money supply. Which brings us to Step 3. Asset prices plummet. Because prices and incomes fell so drastically, the actual value of a dollar increased. So paradoxically, the more debt people paid off, the more the remaining debt was actually worth in real terms. They were literally running on a treadmill that was speeding up in reverse, leading to Step 4, precipitated bankruptcies and a total, devastating loss of confidence.
Finally, we reach the conclusion of our autopsy. Part 5, Turning Points and Recovery, Finding the Cure.
So what was the cure? While FDR's New Deal brought a lot of public works and relief, many modern economists point to something called the expectations hypothesis. See, a major turning point wasn't just monetary. It was totally psychological. By taking the U.S. off the strict gold standard in 1933 and signaling that the government was going to actively fight deflation, President Roosevelt shifted public expectations. People literally stopped hoarding money out of fear and started expecting inflation and economic expansion. That shift in mindset is what finally motivated them to start investing and spending again.
But, while economists sat around debating aggregate demand, everyday people simply had to survive. Households, which were primarily managed by women at the time, drastically adapted their daily economics. Birth rates dropped universally as couples postponed marriages and delayed childbearing. Families relied on expanding their vegetable gardens, raising poultry, and literally repurposing materials, like making dresses for their kids out of animal feed sacks. Heavy reliance on mutual aid between neighbors and extended families became the ultimate safety net when the entire financial system failed them. Ultimately, though, the definitive economic cure arrived with the grim reality of World War II. The mobilization for war required just staggering levels of production. In 1940, government capital investment in industry was just 5%, but by 1943, it shot up to 67%. Plus, over 10 million Americans left the civilian workforce for the military. This massive, unprecedented influx of government spending and complete mobilization of manpower essentially ended the Depression, bringing unemployment well below 10%. The Great Depression forced the world to completely rewrite the rules of finance, creating institutions and regulations designed to act as shock absorbers for the global economy. But as we wrap up this explainer, I want to leave you with a provocative thought to consider the next time the market gets a little volatile. Are the economic and financial guardrails we have in place today truly enough to prevent history from